Hello folks, and welcome back to Boss Economics World, the only show that slices through the central bank smoke and mirrors to show you the gears grinding and sometimes breaking underneath. Today, we're diving deep into the heart of the old continent. The date is September 5, 2025. The air in Frankfurt is thick with the sweet, intoxicating smell of self-congratulation. The European Central Bank, led by the ever-poised Christine Lagarde, has just taken a victory lap. After a brutal, multi-year cage match with inflation, they've slammed the brakes on interest rate cuts. 8 quarter-point decreases are in the books, the deposit rate is sitting at a seemingly placid 2%, and the official narrative, spun with the finesse of a master weaver, is that the beast is tamed. Inflation, they assure us, is heading right back into its 2% cage and will stay there. Mission accomplished. Or is it? Because here at Boss Economics World, we know that when a central banker tells you they're in a good place, it's time to check the fire exits. What we're seeing isn't the end of the story. It's the deceptively quiet second act of a grand, unfolding economic tragedy. The patient's fever might have broken, but the hospital is surrounded by a geopolitical minefield, the hospital's foundation is cracking from internal dissent, and the doctors are arguing about whether to prescribe more medicine or start billing for a miracle cure. So, grab your coffee, pull up a chair, and let's dissect the beautiful, fragile, and utterly terrifying illusion of European economic stability. We'll go from the point that single interest rate decision to the surface, revealing the seismic economic, political, and structural faults it's desperately trying to paper over. Let's start with the headline. The ECB has paused. According to a Bloomberg survey of our fellow economists, God bless their optimistic souls, the consensus is that this 2% rate is the new normal, the Goldilocks level. Not too hot, not too cold. Just right to keep inflation at bay without strangling the economy. President Lagarde says they can now wait and see. Wait and see. These are perhaps the three most dangerous words in modern central banking. They echo the infamous transitory inflation call made by the U.S. Federal Reserve back in 2021, a ghost that still haunts the halls of every major central bank. That was a moment of monumental hubris, a belief that complex, global supply and demand shocks could be wished away. The ECB's wait-and-see stance today reeks of the same dangerous confidence. Why? Because the consensus is anything but. Dig into that very same survey, and you find a profession at war with itself. Respondents are almost perfectly split on whether the real danger is inflation overshooting the 2% target or undershooting it. Think about that. The supposed experts, looking at the exact same data, have come to diametrically opposite conclusions about the fundamental direction of the economy. This isn't a sign of stability, it's a sign of profound, paralyzing uncertainty. More than 40% of these economists expect at least one more rate cut by March 2026. Some, like the team at Intesa Sanpaolo, are even penciling in a final move down to 1.75% because they fear inflation will soften too much. Meanwhile, a full quarter of them are whispering about rate hikes coming in the latter half of 2026. This isn't a Goldilocks scenario, it's a Schrodinger's economy, simultaneously at risk of burning up and freezing over. The ECB isn't standing on solid ground, they're walking a tightrope over a canyon, and the experts below are shouting conflicting directions. Let's add some hard data to this cautionary tale. Central bank forecasts are notoriously unreliable. An IMF working paper from 2023, WP/23/72, analyzing decades of forecasts found systemic optimism bias. Central banks consistently overestimate future growth and underestimate future inflation, especially around turning points. They are, by their nature, reactive institutions masquerading as proactive ones. For the ECB to declare that their 2027 inflation projection of 2% is a solid anchor is to ignore a mountain of historical evidence that their crystal ball is, at best, blurry and, at worst, a snow globe. They've declared victory based on a forecast. But a forecast is not a fact. It's an educated guess in a world where the variables, from a rogue tweet to a blocked shipping lane, can change in an instant. So, if the internal logic is shaky, what happens when we look at the external reality? This is where the wait-and-see strategy goes from being merely complacent to being actively dangerous. The Eurozone isn't a closed laboratory, it's a collection of disparate economies being battered by powerful global and internal forces. The biggest, most immediate threat isn't in a projection model, it's in the bond market. Specifically, it's in the spread between French and German government bond yields. For the non-finance folks, think of this spread as an anxiety tax. It's the extra interest France has to pay to borrow money compared to Germany, the Eurozone's perceived safe haven. A wider spread means investors are getting nervous about France's ability to pay its bills. And right now, that spread is yawning. Why? France is a political tinderbox. The threat of government collapse is perpetual. Its debt-to-GDP ratio, which soared past 112% after the pandemic, remains stubbornly high. Efforts to implement serious fiscal consolidation are met with riots. This isn't just a French problem, it's a European one. France is not Greece. It's the Eurozone's second-largest economy. If it sneezes, Europe doesn't just catch a cold, it gets pneumonia. This brings us back to Christine Lagarde and the ghost of crises past. In March 2020, early in her tenure, she infamously said the ECB was not here to close spreads. The market had a collective heart attack. Bond yields in Italy and other peripheral nations exploded, threatening to tear the Eurozone apart. She was forced to walk it back, but the damage was done. The gaffe revealed a critical tension. The ECB's mandate is for the Eurozone as a whole, but it cannot ignore the financial fragmentation caused by one member's political and fiscal chaos. Today, she insists she's watching the situation very closely. But what can she do? The tool designed for this exact problem, the Transmission Protection Instrument, TPI, is the economic equivalent of a nuclear bomb. It allows the ECB to buy the bonds of a specific country whose borrowing costs are spiraling out of control for no good economic reason. Here's the kicker: according to the survey, only one economist expects the TPI to be used in the next year. Why? Because activating it comes with a terrible condition: the target country must comply with European fiscal rules. Forcing a politically fragile France to swallow a dose of brutal austerity to get ECB support is not a solution, it's a recipe for a revolution. As Karsten Brzezinski of ING rightly notes, Lagarde is trapped. She can't repeat her 2020 mistake, but she also can't activate the bailout tool without demanding fiscal purity that is politically impossible. So, the ECB waits and sees while the financial plumbing of its second-largest member creaks and groans under the pressure of a fiscal black hole and political paralysis. Beyond its internal political woes, Europe is being squeezed by three massive external forces that the ECB's monetary toolkit is woefully ill-equipped to handle. First, the trade war hangover. The prompt mentions tariffs on goods shipped to the US. While a deal in principle might alleviate some uncertainty, the damage is already done. The era of hyperglobalization that powered Germany's export machine for decades is over. We are in an age of friendshoring, nearshoring, and outright protectionism. The U.S. Inflation Reduction Act, IRA, despite its green credentials, was a massive salvo in this new era, redirecting billions in investment away from Europe. For the Eurozone, particularly its industrial heartland, this isn't a cyclical downturn, it's a structural realignment. It's like a champion swimmer discovering the pool is slowly being drained. Interest rate tweaks can't refill the pool. Second, the fiscal impact of war and defense. The conflict in Ukraine has fundamentally altered European fiscal policy. The NATO commitment for members to spend 2% of GDP on defense is no longer a vague aspiration, it's an urgent necessity. For a country like Germany, which has spent decades coasting on a peace dividend, this is a tectonic shift. German defense spending is projected to surge from around 50 billion euros annually pre-conflict to over 100 billion euros by the mid-2020s to meet its obligations and modernize its military. This is, in economic terms, a massive, non-productive fiscal stimulus. Governments are borrowing and spending billions on tanks, jets, and munitions. This creates jobs and stimulates demand, yes, but it doesn't increase the productive capacity of the economy. It's pure, unadulterated demand-side stimulus. This is fundamentally inflationary. So, you have the ECB in Frankfurt trying to gently apply the monetary brakes while governments in Berlin, Paris, and Warsaw are stomping on the fiscal accelerator. They are working at cross purposes, a classic policy conflict that almost always ends in tears. Third, the ongoing uncertainty. From the fragile ceasefire in Ukraine to the next political crisis, the Eurozone is navigating a world defined by volatility. This uncertainty chills the one thing Europe desperately needs: business investment. Why would a German manufacturer commit to a new billion-euro factory when they don't know what their energy costs will be, who their biggest trading partner will be, or if their own continent will be stable in 5 years? The ECB's models, which rely on historical data and rational expectations, break down in the face of such radical uncertainty. Waiting and seeing is a luxury you have when the road ahead is reasonably clear, not when you're driving through a fog bank on a cliffside road. This brings us to the deepest, most philosophical problem reflected in this single ECB decision. It's the paradox of modern central banking. The market is a forward-looking beast. The moment the ECB signals it's done cutting rates, traders and investors immediately pivot to the next question: when will they start hiking? As the survey notes, a significant portion of the market is already getting hawkish, with some betting on rate hikes as early as 2026. This creates a nightmarish communication challenge for Lagarde. The ECB cannot explicitly say, "We promise we won't hike for a very long time," because that would violate their holier-than-thou commitment to being data-dependent. If inflation suddenly reappears, they need the flexibility to act. But if they say nothing, if they just wait and see, the market will fill the silence with its own hawkish narrative. And here's the insidious part: that market narrative can become a self-fulfilling prophecy. If traders start aggressively betting on future rate hikes, it pushes up long-term bond yields today. That means mortgages get more expensive, corporate borrowing costs rise, and government financing becomes more strained. The market, in effect, starts tightening monetary policy for the ECB, potentially choking off the fragile recovery before it even begins. HSBC's Fabio Balboni nails it: the ECB's challenge is to remain fully data-dependent and provide as little guidance as possible, while retaining a dovish bias. This is like trying to tell a hungry lion to stay put without making any sudden movements. It's an almost impossible balancing act. They are trapped. They have to project confidence to anchor inflation expectations, but they can't be too confident, or the market will price in premature tightening. They have to sound dovish enough to prevent a market-led tightening, but not so dovish that they lose credibility on their inflation-fighting mandate. So, let's circle back to that press conference in Frankfurt. The victory lap. The self-assured pronouncements. What we are witnessing is not the dawn of a new era of stability. It is the end of the first, easy phase of the battle. Raising rates to crush inflation is the monetary equivalent of carpet bombing. It's crude, but it works. What comes next is the hard part, the counterinsurgency. It's fighting a multi-front war against structural economic decline, political fragmentation, geopolitical shocks, and a market that is constantly trying to outsmart you. The ECB's pause at 2% isn't a solution. It's a holding pattern. They have put the Eurozone economy into a medically induced coma, hoping that when it wakes up, the world will be a simpler, safer place. But it won't. The structural problems, the Franco-German divergence, the deglobalization shock, the inflationary pressures of rearmament will still be there, and they will likely be worse. So, when you see the headlines celebrating the ECB's win over inflation, remember what you saw here today at Boss Economics World. Don't just watch the headline interest rate. Watch the French-German bond spread. Watch the defense budgets. Watch the German export numbers. And listen, not to what the central bankers are saying, but to the silence they're trying to maintain. Because in that silence lies the truth, they aren't in a good place. They're in the eye of a hurricane, and they're praying the winds don't pick up again. Stay sharp, folks. And keep your eye on the real numbers.